We're back to cut through the noise and tell you what actually moved markets this week. Forget what you've heard on CNBC, Bloomberg, or those echo chamber finance pods. This isn't two economic journalists chatting. And no, we're not interviewing a hedge fund billionaire. This is something totally different. It's a raw, real-time debrief between two AIs, both trained by a former top-tier institutional portfolio manager, breaking down what really moved global markets. The Fed didn't flinch, inflation's still sticky, and gold just hit a record high. Wall Street pulled back as hopes for early 2026 rate cuts got crushed. In Europe, resilient services masked deepening manufacturing stress. Japan is tiptoeing toward normalization. And China, it's running on sentiment and speculative flows, not fundamentals. Before you chase the next breakout or macro trade, pause. Let's unpack what the data is actually whispering, not just what the headlines scream, like share and subscribe if you want real insights, not recycled takes. And stick around, because at the end of this episode, we're dropping the top 5 global risks that could blindside markets next week. You do not want to miss this.
We're wrapping up the week ending September 26, 2025, and honestly, it felt like global markets got caught in a serious downdraft. Things pulled back pretty hard.
Yeah, it was a tough end to the quarter. If you boil it down, the pressure really came from 3 main places. You had Fed officials, really pushing back hard against near-term rate cut hopes.
Right.
Then you had oil prices surging again, adding that cost pressure. And the big one, inflation just, it refused to play ball, didn't retreat like many hoped.
And you could almost feel the nervousness in the price action itself. U.S. stocks slipped. The NASDAQ and small caps, which are usually pretty sensitive to rates, they led the way down. Treasury yields climbed sharply, which, ripples out and hits everything. But the real flashing light for me, gold, soared to a completely fresh record, breaking past $3,800 an ounce.
Wow.
That's just classic fear trade, isn't it? Hedging inflation, hedging uncertainty. It tells you the anxiety level is pretty high right now.
No question. A big flight to safety signal.
Okay, so let's dig into this, starting with the U.S., because honestly, it felt like the U.S. really set the tone globally this week. Stocks there just had their second down week in the last 8. People went into the week thinking, maybe, just maybe, an early 2026 Fed pivot was on the cards.
Yeah, they got a rude awakening.
Definitely a bucket of cold water. So what exactly was the Fed's message, and why did it hit the market so hard this time?
Well, I'd almost call it the return of Hawkish Powell. The chair and other Fed officials were super clear. Look, there's no rush here to ease policy, and they pointed to 2 specific things causing trouble. One, obviously, persistent inflation risks.
Still main worry.
Still number 1. But interestingly, too, they actually called out fairly high equity valuations. That's not something they always do so direct.
Right, that's a bit more pointed.
Exactly.
Yeah.
It wasn't just a casual comment. It felt like a real pushback. The market had gotten way ahead of itself, pricing in cuts, Q1 next year. And the Fed basically said, hold on a second, forcing the market to rewind those bets fast.
Which brings us right to this central conflict in the U.S. economy right now, what you might call the inflation growth paradox. We know the Fed's focused on inflation. Core PCE, their favorite measure, it held steady at 2.9% year over year in August.
Yep, matched July. No real progress there.
And the headline PCE number actually ticked up a bit to 2.7%, the highest it's been in 6 months. So inflation is definitely sticky. But what about the other side of that paradox, the growth picture?
Well, the growth side is kind of roaring, frankly. And that's the real headache for anyone hoping the Fed would ease up. That Q2 GDP number, the revision, it was stunning.
Yeah, tell us about that.
It got revised way up to 3.8% annualized growth. That was up from an already strong 3.3% estimate. And it's pretty much all down to the U.S. consumer just refusing to quit.
Still spending.
Still spending. And if the economy is growing that strongly, the argument for rate cuts gets much, much weaker. It gives the Fed all the justification they need to keep policy tight.
It's almost like the economy's just shrugging off these higher borrowing costs. We even saw that strength pop up somewhere you wouldn't expect it. The housing market, right, which is supposed to be super sensitive to rates.
Exactly. New home sales in August, they jumped 20%. 20% to an 800,000 annualized rate. That just blew away all the forecasts.
Wow.
So think about it this way. You've got this strong consumer building this massive wall of demand, and sticky inflation is the fuel keeping it going. As long as that wall's standing firm, the Fed doesn't really have a compelling reason to pivot, does it?
Not really, no.
If growth keeps looking like this, the path to rate cuts just got a lot steeper, far more complicated than people were betting on even just a month ago.
Okay, that U.S. strength is pretty compelling, almost undeniable right now.
Yeah.
But let's hop across the Atlantic. Does that same resilience hold up in Europe and the UK? The main SCOXX 600 index was basically flat this week, which sounds boring, but I get the sense it's hiding some pretty big differences underneath.
Oh, absolutely. It's a completely mixed picture over there. On the one hand, you did see some surprising resilience in the Eurozone, mostly thanks to the services sector. The composite PMI actually went up to 51.2. That's its best reading in 16 months.
So services are holding up.
Yeah. Services, think travel, hospitality, that sort of thing. It's the biggest part of their economy. And it seems pretty sticky, pretty resistant to slowdowns for now. We even saw a slight improvement in Germany's GfK consumer survey, which was a little bit of a positive sign heading into winter.
Okay, so if services are doing okay, where's the nervousness coming from? Is the market right to be worried about Europe wobbling?
Oh, they're definitely right to worry. Because just beneath that surface strength in services, you've got core confidence really starting to crack, especially in manufacturing. That's the worry.
Yeah, industrial side.
Exactly. Manufacturing growth slowed down across the Eurozone. And the big one, Germany's IFO Business Confidence Survey, that's a key forward-looking indicator. It just plunged unexpectedly. Big drop.
Not good.
No. So the market's trying to figure out how you square sticky consumer spending on, holidays and eating out with businesses getting really gloomy about the future.
Yeah, that makes the whole story much harder to get a grip on. And it sounds like things look even worse if you hop over the channel to the UK. Seems like they're slowing more definitively.
Yes, that seems fair. The UK PMIs fell back to 51.0. And the main pressure point there was manufacturing, partly because of some disruptions in the auto sector, apparently. Business sentiment overall dropped to a 3-month low.
So different flavors of slowdown.
Kinda. You could say the Eurozone is fighting this battle between fragile confidence, surprisingly resilient services, while the UK seems to be dealing with maybe a broader, more synchronized cooling off.
Got it. And we had a couple of the smaller central banks make moves too, right? Anything significant there?
Minor moves, but interesting signals. Sweden cut rates again, down to 1.75%, and they hinted they might pause there. That kind of suggests they think their inflation battle is maybe winding down. Switzerland, interestingly, held steady at 0%. But they're a special case. Their inflation is actually already back inside their target range of 0 to 2%.
Right.
So the big picture takeaway for Europe is really this tension. You've got sticky growth in core Eurozone services, fighting against some pretty fragile business confidence, particularly in Germany's industrial sector and, well, pretty much across the board in the UK.
Okay, let's cross over to Asia now. Two very different stories playing out there, particularly in Japan and China. Let's start with Japan. Equities there actually managed to gain. The Nikkei was up, about 0.7%?
Yeah, just under that, 0.69%.
But the whole market there feels like it's balanced on a knife edge, waiting to see what the Bank of Japan does next, right?
It's a really fascinating situation. We got this inflation surprise out of Tokyo this week. The September CPI number came in at 2.5% year over year. Now, for Japan, 2.5% is still historically high.
Right, different scale.
Totally. But crucially, it was quite a bit lower than the 2.8% everyone was forecasting. And that softer reading, well, it buys the Bank of Japan some breathing room. It takes the immediate intense pressure off them to hike rates, right now.
But didn't we also see signs that internally things are heating up?
Yeah.
Like the minutes from their meetings showed more people inside the BOJ wanting to hike. It sounds like a bit of an internal struggle, even if the data gave them an excuse to wait.
That's exactly the core tension. The internal meeting minutes definitely showed more board members pushing for rate hikes, pushing for normalization after decades of, ultra-easy policy. The institutional pressure is building.
Okay.
Even if the headline inflation number lets them kick the can down the road for a bit longer. And all this uncertainty, plus the strong U.S. data we talked about, plus some local political stuff, there's an LDP leadership race going on. It all combined to push the yen weaker again. It slid to almost 150 against the dollar.
Wow, 149.7.
Yeah, 149.7. The market is basically betting the BOJ is going to blink and delay normalization.
Okay, now let's flip over to China. Shanghai Composite saw some small gains, but the Hang Seng in Hong Kong was down. What's interesting here, you said, is the driver, or maybe the lack of one. Not much big economic news out of China this week. So what is pushing that mainland market even modestly higher?
Yeah, it's not really about fresh macro data right now. The market there seems to be running mostly on domestic factors. sentiment and liquidity. China's got a lot of domestic cash sloshing around right now.
Okay.
And frankly, not that many great places for it to go investment-wise. So this domestic money is chasing a couple of themes. One is perceived policy support. The government's talking a lot about this anti-involution idea.
Right, the push against hyper-competition.
Exactly. Trying to promote more targeted, innovative growth. That's provided some support for risk appetite. And the other theme is just, well, speculation. Areas like AI have been hot since April. So basically, you've got trapped cash flowing into policy hopes and speculative bets. It's creating a bit of a fragile rally, really. More hope than deep fundamental strength right now.
So summing up Asia, then.
I'd say Japan is really at this crucial turning point heading into October. The data maybe says wait, but the internal pressure at the BOJ says move. Big tension there. Meanwhile, China's market is kind of running on fumes domestic liquidity and sentiment. And that kind of rally is always vulnerable to a quick reversal if global risks pick up or if their own data disappoints next week.
Okay, makes sense. So let's look ahead then. After this week of policy reality checks and surprising economic strength, what's on the calendar for next week? That's September 29th through October 3rd. Sounds like the focus swings right back to the U.S. labor market.
Absolutely. It's a huge week for U.S. data, pretty much designed to either confirm or challenge that hawkish Fed story. The big one, of course, is Friday, October 3rd. That's when we get the jobs doubleheader, non-farm payrolls and the unemployment rate.
The main event.
Definitely. But before that, we get other clues about labor market stress. JOLTS job openings are out on Tuesday, September 30th. And we also get the really important ISM surveys, manufacturing and services PMIs. Crucially, those include details on prices paid and hiring intentions.
Right, forward-looking bits.
Exactly. These reports are really going to shape the narrative around whether the Fed stays firm or if maybe those cracks in the labor market are getting deeper than they thought.
Okay, what about internationally? Europe's got its eye on inflation too, right?
Yeah, Europe's focus is squarely on its own inflation picture next week. Eurozone flash CPI comes out Wednesday, October 1st. That's going to be the main event for European markets. And then the UK rounds out the week with its GDP and retail sales numbers on Friday.
And Asia. Anything key before the holidays?
For Asia, the main thing to watch is the China NBS manufacturing PMI on Tuesday, September 30th. That's the last big piece of mainland data before China shuts down for its Golden Week holiday on October 1st and 2nd.
Right, Golden Week.
And in Japan, we get the Bank of Japan's Tankan survey on Wednesday, October 1st. That's a really important measure of business confidence there, so that'll be closely watched given the BOJ debate.
Okay, so the data is going to dictate a lot of the strategy. Let's shift to that strategic view now. Based on everything we've just talked about, the Fed pushing back, the strong U.S. consumer, the wobbles in Europe, the uncertainty in Asia, what are the absolute top risks investors really needed to keep on their radar for the week ahead?
Right. Let's lay out the hazard map for the next 5 trading days.
Okay, risk number 1.
Risk number 1, the U.S. labor market worsens further. Look, we saw some slightly worrying signs in the August jobs report. If Friday's September non-farm payrolls number confirms that slowdown or looks even weaker, it puts the Fed in a really tough spot.
A policy dilemma.
Exactly. Do they keep hammering away at sticky inflation, or do they suddenly have to start worrying more about growth slowing down too much? A really weak jobs number would be a strong signal of deeper economic softening. How the market reads that number on Friday could be pretty explosive.
Okay, makes sense. Risk number 2.
Risk number 2. Sticky U.S. inflation just keeps pressuring the Fed. We already know core PCE is stuck near 3%. The next clues on inflation pressures will come from those forward-looking bits in the ISM surveys we mentioned.
The prices paid components.
Right. If we see any signs of prices picking up again in the ISM reports, especially the services PMI on Friday, or if wage data looks strong, then the market might just fully price out any rate cuts for early 2026. The risk here is that higher for longer becomes the absolute base case.
Got it. Risk number 3. Sounds like Europe's turn.
Risk number 3. Eurozone inflation surprises to the upside. The ECB kind of wants to pivot, but that sticky services growth we talked about is making them nervous. If that flash CPI number on Wednesday comes in hotter than expected, it could basically kill off hopes of an ECB pivot anytime soon.
And spook the bond markets.
Definitely spook the bond markets, especially in the periphery. It would just reinforce the idea of continued monetary tightening over there.
Okay. Risk number 4 takes us back to Asia.
Risk number 4. A China PMI miss undermines that fragile recovery story. We talked about China running on sentiment and liquidity, right? If that official NBS manufacturing PMI on Tuesday comes in weak, showing activity is actually slipping, it would really feed those worries about structural deflation risks not going away.
And that could hit markets.
Oh, yeah. It could easily reverse those recent speculative gains in Chinese stocks and probably sour sentiment towards commodities globally, too. A weak China number hurts a lot of markets.
And finally, back to that tension in Tokyo. Risk number 5.
Risk number 5, Japan policy uncertainty and yen volatility. The BOJ is just caught in this bind, needing to normalize policy versus still relatively soft domestic inflation. That Tenkan survey on Wednesday will give us a clue about whether businesses are feeling confident enough to handle tighter policy, especially with all the political uncertainty.
So the risk is a misstep.
Yeah, the risk is any kind of policy misstep or maybe an unexpected hint about tightening sooner rather than later could trigger really big, sharp moves in the yen. And a volatile yen has knock-on effects for global currency markets and risk appetite, particularly in Asia.
Okay, that's a lot to watch. So pulling it all together, what's the big takeaway for you, the listener, as we head into October? The main theme feels pretty clear, doesn't it? Markets are basically being forced to rethink the Fed's playbook.
Absolutely. They have to confront the reality that inflation just hasn't cooled enough, and that incredibly resilient U.S. consumer is basically giving the Fed all the ammunition it needs to stay hawkish, potentially well into 2026.
Which leads to the big question, right?
Yeah, the provocative question I think you need to mull over is this. Is the economic strength we're seeing now, that high GDP, the strong consumer, is this just a temporary blip, a brief pause, before central banks have to pivot hard because things eventually break? Or are the central banks actually succeeding in setting the stage for a much longer period of higher interest rates, something the market still hasn't fully priced in or accepted?
Pivot soon out of necessity, or higher for much longer.
That's the core conflict. That tension between surprisingly strong growth and restrictive policy is really the key challenge as we kick off the fourth quarter.
Use this deep dive to help shape your own perspective on that crucial conflict.
Still watching? Then you're one of us, someone who actually wants to understand the markets. If this helped you think sharper, tap like, share the insight, and hit subscribe. Smarter markets need smarter minds. Let's grow this together. New AI-powered episodes drop every week. Imagine this format: AI-powered, sharp, fast, built around your industry, your firm, your market. For investors, leaders, or teams that move fast, we create custom podcasts designed to inform and impress. Curious? Contact us to build yours. Bespoke, bold, built by Flamingo's Research and Advisory.